Good afternoon for all you lifetimers out there. This is Swain. I'm one of the financial advisors with LifeTime Asset Management, and you're joining us in one of our ongoing series of episodes of webinars that we're doing. And today we're going to be discussing, I think, a very important topic, in particular for some of the younger clients that we have. Mortgages, in particular for first-time home buyers. So we have as a special guest today, Dan Flynn, who will be presenting for us. So hi, Dan.
Hi.
Before we get started, feel free to ask questions. You can go to info@lifetimeasset.com and ask any questions, and we'll try to get all the questions in before the session's over. If by chance we can't do that, we will reach out to you and answer those one-on-one a little bit later on. Also, as usual, we will be recording this session, so you'll be able to go to our website. And as I have said frequently in the past, you can actually go there and binge on all of these if you would like to at one time. Obviously, we can send these. One of the other things that we can do for our clients, if someone would be interested, we can send these linked to others. So if you know someone that would benefit, let us know. All right, let me introduce Dan. Dan is from Prosperity Home Mortgage. He's branch manager there, full service mortgage broker, banker specializing in residential and refinance loans. And he's been in the industry since '07, so a wealth of experience. I just found out that Dan is a graduate of University of Pennsylvania, so obviously a smart guy in that respect. A lot of experience in real estate, FHA loans, and supporting first-time home buyers. In fact, I would suggest, like it is for us financial advisors, you probably have a special passion helping some of these younger people. Do you not, Dan?
Absolutely. Absolutely. That's one of the most satisfying things we can do in our business is help someone get into their first home. And our efforts in that respect, hopefully that turns those folks into customers for life. If we make the first home purchase a memorable experience, that leads to repeat business. So we want to make sure we take great care of our first-time home buyers.
Great. So I'm sure that not only first-time home buyers, but many of us have misconceptions. What do you see most frequently, the most frequent misconception for these first-time buyers?
Yeah, first of all, thanks for the opportunity to do this with you and bust a couple of those most common myths that we see out there when people talk about financing the purchase of a home. Probably the first and most important one is, how much of a down payment do I need to purchase a home? And the most common misconception that we see is the idea that you have to have 20% of the purchase price to put down to be able to purchase a home. So there are so many different ways that we can approach the down payment. We have loan programs that are 100% financing. We can do loans as low as 3% down on a conventional mortgage, 3.5% down for FHA loans. So there's just a whole range of programs that are out there that allow you to purchase a home with less than 20% down. And we still get that just an awful lot when talking with folks, the perception that you need 20% down to buy a house.
Right. Well, that's common. Well,
Yep.
Obviously, we greatly appreciate that's I think, a very good comment to introduce your services and impart some knowledge for our participants today. So take it away.
All right. Let's see if we can master the technology. That's probably going to be the hardest part of this process here. So I'm going to share my screen, and we're going to walk through. Well, hang on just a second. There we are. So basically what we hope to do today is to get you educated about what the home financing process looks like, what lenders are going to be looking for, some do's and some don'ts, and just try to get folks better prepared for the mortgage financing process. Now you'll see the first screen We're actually Prosperity Home Mortgage, but in this market, we are doing business as FM Lending Services because we have such a great reputation in the Triangle that we have kept that FM Lending Services as our brand here in this market. And you'll see my partner, Mike G, he and I work together. And so we're able to bring kind of double the experience and double the coverage in working with our clients. So we'll start by talking about what's the number one question we receive from buyers, and that is, how do I qualify for a mortgage? And we will try to walk you through that process here this afternoon. And so the characteristics that we look at as lenders kind of break down into 4 different categories. Certainly income is a big piece. Do you have enough income to support being able to pay the mortgage payment that you're proposing to take on, as well as any debt load that you're carrying, car loans, student loans, et cetera. The next question is, do you have a sufficient down payment? Do you have skin in the game? So generally speaking, the more a purchaser puts of their money into the transaction, the more comfortable we are with making a loan to someone because they have skin in the game. And the worst outcome that we can have as a lender is if we make a mortgage and you're not able to make the mortgage payments and we have to come and foreclose. That is a bad outcome for everyone. And so what we want to do in all of this analysis is to try to make sure that that doesn't happen. And a larger down payment is typically an indicator that it's less likely to run into that kind of event. The third thing, of course, is credit history. That's an extremely important part of our process. Are you able to manage your finances such that you meet your obligations on a monthly basis? And that's reflected these days in a credit score. Of course, everyone hears about credit scores. We'll touch on that in a little more detail further in the process. And then the last item that we have to take a look at is the collateral for the property and for the loan. The reason we want to know about the collateral is, again, goes back to that foreclosure eventuality. So we do not want foreclosure. We want to make a loan, have the borrower pay us back, and have a nice, good relationship. But if that doesn't happen, we have to come and take back the property. And we want to make sure that the collateral that we are taking back that is securing our loan is going to be worth what is being paid for it, has been properly maintained. And if we have to foreclose and then sell it back on the market, that we have a easily marketable piece of property to sell. So we'll talk a little bit further about sufficient income. So right now, lenders typically use 2 different what are called ratios when analyzing whether to give a borrower a loan. The first is typically referred to as the front ratio, and that involves just the total housing expense expressed as a percentage of your gross monthly income. And that housing expense involves not only the repayment of the loan, but almost exclusively, we will be escrowing for property taxes and homeowners insurance as part of your mortgage payment. Now, escrowing, there's a lot of mystery around that. And the way to look at that is that it is simply a savings account that we establish and maintain for you and that you make monthly contributions to in anticipation of our paying your future property taxes and homeowners insurance bills. So it's kind of a forced savings plan that gets you set up for success so that you can make that, so those property taxes and homeowners insurance bills get paid each year. So those are 2 components of the mortgage payment. And then the other item that we might talk about is PMI, private mortgage insurance. That's something that comes up when you're putting less than 20% down. And one other component to the housing expense calculation are if your property, for instance, if you're purchasing a townhouse or a condo, you might be looking at what are called homeowners association dues. That is an additional expense that we roll into the calculation of that front ratio. And we typically want to see that ratio about 33% of your gross monthly income. The second ratio we're going to look at is calculating the entire housing expense, and then we're going to add your monthly debt obligations. Now, these are debt obligations, so we would not include things such as utilities, food, entertainment, etc. These are things that you're obligated to pay, such as credit card bills, student loans, car payments. We also have to incorporate alimony or child support if those are a factor as part of your finance package. And we don't want to see that ratio, we call it the back ratio. We don't want to see that higher than 45%. There are instances where we can go higher than that, but that if we're going to do that, we have to see other strengths of the loan, because it's a whole puzzle. It's not just looked at in isolation. For instance, if you're putting 50% down and you have an 805 credit score, we may have a little more flexibility with respect to your debt to income ratio, because there are other strong aspects to the loan application. So these are guidelines. They're not hard and fast rules, but they are starting points for us to look at when determining whether to give you a loan or not. And then one other thing I want to touch on this screen is what the income is. So we have to make sure that the income is stable and likely to continue. So when we're talking about the pre-qualification process, we're going to want to find out how much you make, but we also want to know the source of it. Because, for instance, if you happen to have just taken on a job that is a straight commission job, maybe you've just gotten a job selling cars and you've been in that field for 6 months, well, that is not a sufficiently long enough time on the job for us to determine what your stable income pattern is going to look like over a period of 2 years. And so we want to understand what the source of the income is. And that's going to be part of this screen, is determining debt to income ratios. So that's an important piece of it. The next thing we're going to look at is down payment. And again, we touched on that earlier in an overview. So we want to make sure that you've got enough money to meet minimum down payment requirements. One of the things we want to make sure that you don't do is borrow those funds on an unsecured basis. So your down payment can't come from like an unsecured loan. There are ways to use assets on a secured basis to borrow your down payment, but that's a fairly special set of circumstances that you definitely want to consult with your loan officer on before trying. But what we're going to want to do as part of the process is make sure that you've got sufficient funds to cover not only the required down payment, but typically speaking, you're also going to be incurring closing costs associated with the home purchase. And those closing costs will involve our fees, the cost of the appraisal, there's an attorney involved, title insurance, homeowners insurance. And those costs are all rolled into what we call closing costs. And you're going to need to be prepared to document that you have, again, not only the required down payment, but also the closing costs associated with it. And again, we touched on this briefly earlier. Why is the loan to value ratio is important? And the reason is because the higher the down payment that the borrower makes, the lower the risk is to us as the lender in the event that we have to come and foreclose on the property. So if our loan is only 50% of the value of the property and the loan isn't, for whatever reason, isn't paid off, and we have to come and foreclose, then we're likely, when we go to sell the property back after we've foreclosed on it, we are likely to recoup all of that 50% loan. Whereas if we've done a 97% loan, it's far less likely that we're going to be able to recoup all of that loan that we've advanced. So that's an important piece of it. And this screen, this is the area that typically represents the highest obstacle for people who are trying to purchase their first home. And that's where, if you're working with a good lender, we need to be able to identify options to overcome that barrier, because it is a barrier, and there are ways to overcome that. Sufficient credit history. So this, of course, is a real important part of the process. Now, I will say this, we rely heavily on credit scores, but you're not just a score. There's other parts of the process that we look at. So in general, the higher your credit score, the better financing terms you're going to get, lower interest rate, lower fees. And so it's really important as you're starting to think about purchasing a home is to get an idea as to what your credit scores are. Now, a note on credit scores is we as mortgage lenders have our own separate scoring model that we have to use in determining interest rates, et cetera. And that scoring model is almost always results in lower credit scores than you might get from a consumer-facing model such as Credit Karma or Mint or what have you. So those places are a really good place to start to get an idea as to kind of where you stand in general, but don't be surprised when you go to start the mortgage financing process that the lender that pulls your credit comes back with a different credit score and often lower credit score than what you've seen on, again, some of those consumer-facing models. So keep that in mind. And then if you do have things that you need to work on in your credit, get those done and get them done as soon as possible. You can have a fairly minor derogatory credit item pop up on your credit report. And if you don't get it taken care of quickly, that derogatory item continues to drag down your scores every month, because these days creditors are reporting that derogatory every single month. So it shows up as a new derogatory every month. So the sooner you can kind of stop the bleeding and get that taken care of, the more quickly your credit scores will start to rehabilitate, and they'll start to climb once you've taken care of any type of derogatory credit that might appear on your credit report. What's a credit score? So a score incorporates a lot of factors. It's a really sophisticated analysis tool that looks at your credit history, the type of credit that you have, how long you have had that credit outstanding, and balances as against credit limits, particularly with respect to revolving credit. So the scoring model will look at a credit report and say, all right, here's a credit card with a $3,000 limit and the balance is $2,900. So that scoring model is looking at it and saying, oh, this person is maxed out. Now, the alternative is to have two different credit cards with $3,000 limits apiece, have a $1,400 balance on one and a $1,500 balance on another. That profile is going to have a higher credit score, even though it's the same amount of debt as expressed as a percentage of the actual credit limits. It's lower. And so that's a way, there are some ways to try to manipulate your credit scores if you have a good idea as to what's behind the credit scoring model. But the problem is that all three of these bureaus, Experian, TransUnion, and Equifax, some part of part of the way of there are ways to kind of game the system and manipulate your credit, but they also keep quite a bit of it a mystery so that consumers don't game the system. But in general, what you can say is obviously pay all your debts on time. One of the things that I think is really overlooked is check your mail. One of the things that we see a lot is if you go to a doctor, you go to a dentist, and you have some work done, and your insurance covers almost all of it, and then you get a bill in the mail for $22, and you say, well, my insurance covered this, I don't have to pay this. And then it turns into a $22 collection on your credit report. It tanks your credit, and it can be really frustrating when we see someone who in general is really good at managing their financing, but just didn't pay attention to what they're getting in the mail. And then we have to deliver the news that their credit scores are lower than what they thought it would be. So pay attention to the mail, particularly if you've had any type of medical or dental work done. That is an important piece of it. Pay your bills on time. Obviously, severe derogatory credit events such as a bankruptcy or a foreclosure are going to be outsized in determining what your credit scores are. Typically speaking, it takes, because credit scores incorporate how long a person has had credit, it is a little more difficult for younger people who have had credit for a shorter period of time to have really, really high credit scores. But that's just something that has to come with time. And I know that that is sometimes a source of frustration for younger people who pay everything on time, but have credit scores that may not reflect the absolute highest that they might be able to get. And again, that's just a matter of passing time. And then the collateral piece of it is something that we address, of course, by having an appraisal done. Now, an appraisal is a report that a licensed individual goes out, and it is designed to report specifically on value and marketability. And one of the important distinctions we have to make is that it is not a home inspection. In the purchase transaction, you would typically hire a licensed home inspector to go through the property and make sure that the roof doesn't leak and that the plumbing system is working correctly, the wiring is safe, etc. That's a home inspection. An appraisal is basically a report that compares the property that you're proposing to purchase, and it compares it with comparable sales that have closed recently. Typically, they want to be close to the neighborhood that you're purchasing in, similar style and similar square footage of property, so that we're comparing like properties. And then they'll make adjustments for differences, perhaps in square footage or number of bathrooms or such like that. And it arrives at a marketable value. And what we as the lender want to know is the contract price supported by the appraisal and the data, the market data that is included in that appraisal report. So that's an important piece of the puzzle. That is something that we handle as part of the process. We are required in our lending process to control the ordering of the appraisals. So that's not something that you would have done as outside of the lending process. Is something you would do. The home inspection is something that, while it's not required, we would very much recommend it. All right, now that you understand how to qualify, let's take a look at the old school approach, the way things were done some years ago versus the way things are done now, particularly in kind of the hyper-competitive real estate market that most of us are operating in right now. So the way your folks might have bought a home, find a realtor, you go out, look at homes, you put a contract on a house, you get your offer accepted, and then you contact your lender and you go through the loan process, and hopefully you get approved, and hopefully you close on a home. The way things are working these days is a little bit different. There are many occasions in which the first contact is with the lender rather than the real estate agent. And if the first contact is with a real estate agent, that real estate agent will make sure the very second contact is with the lender. Real estate agent is, wants to make sure that if they are investing their time and energy in selling you a home, that there is going to be a successful conclusion, a closing involved at the end of that process. And one of the biggest hurdles, as you might imagine, is the financing piece. So if you speak with a reputable real estate agent, the chances are good that the first conversation will involve referring you to a trusted lending partner to get the pre-approval process started. Or you can get that process started right with the lender directly, and then the lender can connect you with a trusted real estate partner that they work with. Either way, the second step, get approved, is particularly important. Lending guidelines have changed. Some have gotten a little stricter. Some have stayed the same, but it is a constantly changing environment. And it is extremely important to make sure that as you start making commitments for the purchase of a home, that you have a complete and reliable idea that you're going to be able to get mortgage financing at the end of the process. So getting approved first and then looking at homes is the right step. That also allows you to kind of pin down what price point you should be looking at. If you're setting a mortgage finance, a monthly housing expense goal of $1,500, Well, you need to know what that price point looks like so that you're not looking at houses that are well beyond your budget for housing. So a good conversation around that is going to allow you to be more efficient in looking at homes. Then you put a contract on a house. You hope you put a contract on a house. So over the last year, the market is such that purchasing a home is a really difficult and sometimes stressful process. So generally speaking, there's far less supply of housing out there for buyers to buy than historically has been the case. And so oftentimes a property will come on the market, and if it's in a popular neighborhood and price point, you're going to have a lot of people that are interested in purchasing that home, multiple offers, and you're going to have to put your best foot forward. And part of that best foot forward is going to be proof that you have gone through the lending process and that your financing is intact. So that's one of the things that a seller is going to weigh when they're looking at multiple offers is, well, has this person gone through the approval process, and who have they gone through the approval process with? Is it a reliable local lender, or is it just, something where you input some information on the internet and got yourself a pre-qualification letter? So that makes it more likely that your offer is going to be accepted. And then you go through the mortgage financing process and you close on the home. Why is it so important to qualify first? Guidelines have changed, and I can attest to that. So Guy said I started in 2007. I started with FM lending in 2007. I started lending in 1992. So I can tell you that there are so many things that have changed and continue to change. They change every day, and it's really difficult, even as a lending professional, to stay on top of all the changes. So my MO is to make sure that I know where to get the information. I cannot possibly store all of the information required to do this job in my head, but I know where to get that information. Tighter loan underwriting guidelines. That is, I can say for sure, not only just guidelines, but the documentation that lies behind those guidelines. So we want to make sure that we are able to provide documentation around anything that we put into an application. Bank statements to support the down payment documentation, pay stubs and W-2s to support the income and employment. So those things are really important and have become a little more thorny as we go through the process. And then the competition, as we said, for properties has increased dramatically. And in this market, it is really almost a certainty that you're going to be working in a multiple offer situation. That's why you need to put your best foot forward. And that's why when sellers are looking at offers, they're going to be looking at not only are they qualified, but how have they been qualified? Have they been thorough in their qualification? So things you can do to kind of streamline the process and make sure that your process is going to go smoothly. I'm going to start by saying this before getting into this slide. Make sure that you're dealing with a reliable, experienced loan officer and a local mortgage company. And the reason I say that is because if there's not someone who's actively involved in the community that's involved in your process, it's someone who's behind a 800 number in some Midwest city. They have less skin in the game, and if they don't handle your loan transaction well, they just move on to the next person that's called the 800 number. Whereas someone who's involved locally in the community, our reputation is on the line every time we handle a loan transaction. And I think that's why it's so important to work with someone local and reliable. So be prepared to gather your key documents before you meet with your loan officer. And those include W-2s, pay stubs, tax returns, bank statements, driver's licenses. And that is a starter kit. So that's not all inclusive. There may be certain aspects of your individual loan application that requires more documentation and more explanation. So that is kind of a baseline of documentation, but that's not all that we might need. Make sure, and this is really important, particularly in this market, be timely. If the lender is asking you for a piece of documentation, we need you to respond as quickly as possible, because the clock is typically ticking and ticking pretty quickly down to the deadline of a close date. And that goes with the real estate agent as well, and the loan processor, who typically handles a lot of the paperwork aspects of your loan. If you get a request for documentation from them, you want to respond as quickly as possible, and then be in touch. Now, this is something that, this goes both ways. So it's critical that your loan officer, your loan processor, and your real estate agent are communicating effectively with you. But it also goes the other way. You need to make sure and stay on top of things, and make sure that if you haven't heard from one of those players in a couple of days and you're coming down to a closing date, that you reach out and make sure that you stay in touch. It's not a good idea to just assume everything is going perfectly smoothly and that you don't need to do anything. You are not bothering us when you call. You are the reason for our business. So be in touch and stay in touch. That's for sure. So the steps in the process, there's typically an initial consultation. These days, that's happening over the phone. We don't often meet face to face. I truly hope that changes just as quickly as possible, because my wife is getting a little tired of listening to me do business here in the dining room. But we're going to exchange information. A lot of that process is going to involve my asking you what your goals are, what you're looking to do, where do you want to end up, okay? And then the second part of that is I want to make sure that on that first call, that you're going to get a good sense for what the rest of the process looks like, okay? That's going to involve a quick interview. We're going to get the information over the phone. We have a website that you can use that is pretty user-friendly, and you're going to put all your information on. We're going to look at a credit report, and we're going to say, all right, you're qualified for X amount of purchase price. This is where you want to start your home search, right? Then you're going to get with your real estate agent and talk about what that's going to look like as far as a house. Pre-qualification, that is really just a discussion over the phone with a credit report. Preliminary approval involves perhaps running your loan application characteristics through an automated underwriting system and getting a preliminary approval. Full and true pre-approval involves sending out loan disclosures, collecting all of the documentation, such as bank statements, pay stubs, W-2s, et cetera, and running that in front of an underwriter so that you get a commitment letter. That, in my opinion, is what a full pre-approval represents, is having an underwriter look at all the documentation. And these days, we're doing that more and more often, just to give a little more strength to buyers' offers, because we can present a commitment letter rather than a pre-qualification letter. We want to get all the documentation. That's something that I will do at the start of the process. And then as the loan goes through the process, the loan processor steps in. And if there's any follow-on documentation that we need, then that's what she'll be asking for. Then you find your home. Then we finalize the loan application. We send out loan disclosures. That's where the rubber meets the road, and you get a chance to lock in your interest rate. You will see a detailed breakdown of all the closing costs, what the mortgage payment is going to look like, et cetera. At that point, we're also going to order an appraisal. The attorney that you end up working with will start working on the title search. Title search is simply, they go back into the court records and make sure that there are no issues with respect to the title to the home that you're proposing to purchase. And based upon that, issues you what's called a title insurance policy. And that title insurance policy insures you against loss if there's ever any problem to the title to the home, now or in the future. And then you get a commitment letter. If you haven't gone through the pre-approval process that I just described earlier, this is the point at which you get a commitment letter. There may still be some outstanding conditions, such as homeowners insurance. Flood insurance is not typical for this area, but there are areas that do require that. If you're getting new construction, you're going to need a certificate of occupancy. That's something that the builder would provide, but we would need to have that as part of our loan package. And then we're gonna send out a closing package, and in connection with the attorney that you select, we're going to generate what's called a closing disclosure, and that closing disclosure will be the final figures. It will show how much you need to bring to the closing, and it will show your final mortgage payment. At that point, most attorneys at this point are requiring wires rather than certified checks. Some attorneys are still accepting certified checks, but mostly attorneys have gone to wires. So you will go to your bank, you will wire the required funds to the closing attorney's office, and then you will go to the attorney's office and you will sign a bunch of horrible paperwork. And at the end of it, you will get a set of keys and you will be a homeowner. And that is in general what the process looks like. And our job is to make sure that that process meets all of the dates required as part of the contract, that you have an idea, you have a good understanding and comfort level with every step of the process, so that when you get to the closing, you've got a really comfortable experience, and you're going to go in and be able to sign all those closing documents with confidence. So that's what the process looks like. Tips for an easy loan approval. Make sure you continue to pay all your bills on time during the process, because if you don't, that can affect your credit scores and can affect your ability to close on your home purchase. Keeping copies of updated pay stubs, bank statements, etc., super important. This I've always felt should go without saying, but it often doesn't. In fact, we just had this happen this week. Someone changed their job and we didn't find out about it until the day before closing. Now, luckily enough, we were nimble enough to find out the information on the new employer, get the verification of employment form done, and that borrower is able to close on time. But that is not something that we would suggest. Changing jobs during the process can add real heartache to your mortgage process. Don't open up any new credit. What really drives us crazy is when you go furniture shopping or you want to buy new appliances and you want to get that extra 10% discount, and so you open up an account with Home Depot or Rooms to Go. That, in some instances, can actually affect your entire loan qualification. But even if it doesn't affect your qualification, it means that we then need to get documentation from you about that new debt. And that can be really difficult to get, particularly as you get closer to your closing date. So try to avoid at all costs making any type of new credit during the process. Don't tap out, don't buy a new car with the funds that you were planning to use as a down payment, because we have to make sure that you have those funds ready to close just prior to closing. So don't make any big purchases that's going to affect the amount of funds that you've got in your bank accounts. Don't transfer funds. This is real big a bugaboo. The paper trail that we have to create around funds to close is significant, and it gets significantly harder if you're moving funds between bank accounts. So try to just keep that kind of activity to a minimum. And if you're getting a gift as part of the home purchase, that's not a problem at all. Every single loan program that we offer allows specifically for gift funds to be used. But we need to know about it and we need to document it. So if we see a large deposit pop into your account 3 weeks before closing, we're gonna ask where it came from. And if it is in fact a gift, we're gonna have to document that through the signing of a gift letter and documentation of the transfer. So let us know. That goes back to communicating with your loan officer. Tell us what's going on. And hopefully, if you're dealing with a good loan officer, he or she will elicit that information from you by asking the right questions. That's a big part of the process. Yeah, don't hesitate to ask your mortgage consultant before making changes to your employment. Please check with us. Don't stop making payments on existing accounts. Don't make major purchases. These are all things that we just talked about. One of the things that sometimes is something we're asked about is depleting savings to pay off credit debts. Well, that can be a fine line. I do like the idea of paying off debts, but if you need those funds for the purchase of the home, that may be something that you want to accomplish over time so that you're able to purchase the home with the funds and then over time put together a plan to pay down debts. Don't make large deposits in your bank accounts. These are things that we all just talked about in the last screen. Doesn't need to be difficult. The way I present this is that this process, purchasing your first home, is going to be stressful. If you are working with the right real estate agent and the right lender, we can bring that stress down to a manageable level so that you're actually comfortable going through the process. That involves being educated about every step of the process, making sure that the realtor has explained every step of their process, the lender has explained every step of their process. And then, if every step of the way, everything happens exactly as it has been explained to you up at the front of the process, then you will have a good comfort level, and you'll be able to enjoy the excitement of buying your first home. But communication is the key. And if you're not getting that, then find another real estate agent, find another loan officer, because you deserve it and you need it. So that's kind of my soapbox speech there. Get all your qualification documents together now. Get them to us early and often, and that will make things easier for you. React quickly to any documentation requests. We've already talked about that. And stay in touch with all the players that are involved in your home purchase. And that comes to the end of my presentation. That's me. That's my partner, Mike. We have a lot of fun. We handle a lot of business, and we really enjoy this business. I hope this has been helpful for you. And I'll turn it back to Guy for any questions.
Dan, fantastic. I was trying to count up as you're going through your presentation here, how many mortgages I've acquired over the years. I think I decided I've had 9 residential and a few commercial. But boy, I learned a lot in your presentation today. I think we should have not called this first-time home buyers. Any potential home buyer should have been participating in this presentation. I thought it was outstanding. So we greatly appreciate you sharing this information with us.
Hope it was helpful.
So we have a few questions, as you might imagine.
All right.
First of all, this one, now I'm reading them directly from this, so if you covered it, forgive me, but maybe a little bit of reiteration would be fine. How much should new homeowners budget in for future maintenance and repairs on a home?
Yeah, that's a really good question. One of the things you can do is we have an online homebuyer education course that I can email out to anyone who'd be interested in seeing it. And that goes into all aspects of home buying, including, all right, now you closed on a house, now what, right? So how much should you budget depends upon a lot what kind of property you purchase. So if you buy a townhome where the exterior maintenance is handled by the homeowners association, well, you don't need to budget very much at all for exterior maintenance, and you just need to make sure that you're budgeting for things like appliances and other internal parts of the home. One of the things that you can do to mitigate against that is if you're purchasing a home, you can get what's called a home warranty, and that is it's an insurance policy that it covers appliances, major systems, plumbing, electrical, et cetera. And that is something that I have seen first-time home buyers use to great advantage. So during the first year, if something goes wrong, all I have to do is pay a deductible, and something that is covered gets replaced or serviced as part of that insurance plan. But in general, you have to take a look at whether you're buying new construction or an existing home. If it's a 40-year-old home, you're going to have more upkeep than if you're buying a new home. And I think you just need to kind of look at the home that you're purchasing and think through what you think you might need to do over a year's time, and then spread that out over 12 months and try to budget for that.
And personally, I can attest to the fact that if you buy a new home, you still have repairs and expenses. So you're not exempt if it's new.
That's
Okay. What do self-employed buyers need to know to provide the quality to provide for qualifying for a loan? You mentioned it's more difficult if they're changing jobs or they just only had a job for a relatively short period of time. Are there
right.
any, someone comes to you, they've just started a new career, they're making good money or anticipating, is there any way to fix that issue?
That is, so self-employed borrowers are faced with real specific obstacles to financing. So typically speaking, we want to see a 2-year history of self-employment in
Right.
this field, and we are going to look at the tax returns that they've filed, either as a sole proprietorship on a Schedule C, or if they're incorporated, the various corporate tax returns. And we're going to look at the bottom line figure. And, the impulse, perfectly natural, is to minimize income tax liability. And that makes sense. I try to do it myself. But when you're self-employed, that can sometimes become a double-edged sword, because the net income that you put down on your tax returns is the income that we will use to determine whether you qualify for mortgage finance. And again, we do want to see a 2-year history of that type of income. And that's similar to if you're a W-2 employee, but you're, for instance, 100% commission, we want to see a 24-month history of that as well.
So are you suggesting if someone's has just changed jobs, so they may have to wait a year or two before they could get a
So
mortgage?
that's another real misconception. So if someone's going from a salaried job to another salaried job, we can close that. We can close a loan with an offer letter for the new job without them ever having started. So they can actually start the new job after they have closed on the home purchase. So if it is salary to salary, then we have a lot of flexibility on it. But if the income is variable in any way, for instance, if you're an auto mechanic, you get paid by the piece. If you're going from a salary job to a commission sales job, if you're going from a W-2 to a 1099, those are the areas there where the income gets a little difficult to document. And so if you're thinking about buying a home, I would suggest strongly, if you're self-employed or you're thinking about going self-employed, get with a lender first before making any permanent commitments.
Right. How long does the application process take from start to finish?
It depends upon the borrower. We can be awful swift, and in fact, in this market, we find ourselves needing to be swift. So I just got a contract in just this afternoon for a closing on the 31st of March. And because we have prepared this borrower to react properly and quickly, that's not really going to be that much of a problem. I wouldn't recommend that kind of a time frame, just because there's a lot of things in addition to the mortgage financing process that has to happen during a home purchase. Home inspections, you got to line up homeowners insurance, and there's a lot of other things that are going on. You got to set up utilities, movers, etc. So I would suggest that a more relaxed process would involve anywhere from 35 to 45 days. That's start to finish, from contract to close. But we are seeing a lot of offers that require a short closing period, and we can do it in as quickly as 3 weeks if necessary. But at that point, you really need to react quickly to anything we ask for.
Yeah. In the market today, certainly here in Raleigh, and we're finding it with people trying to acquire coastal property too, that in many cases it requires an offer above the asking price. So getting that letter, getting pre-approved for that is essential. But do you have any how can you help people to acquire the property that they really and truly want in this tight market?
Right. So here's what we do with our real estate agent partners. So the first thing we'll do is we will take the steps to get a person truly pre-approved and underwritten. So that allows us to go to the seller side and say this borrower has applied for their mortgage and has been underwritten and approved. The other thing we'll do is the buyer's agent, the agent representing the buyer, will ask me to call the listing agent, that is the real estate agent representing the seller. And I will make the phone call, introduce myself, and I will talk about the particular strengths of the financing piece of our buyer's offer. I will also talk about the fact that if in fact they are trying to go over value, one of the key pieces to the process, if you're trying to go over the asking price, is will the property appraise? Well, our company uses only local experienced appraisers. We don't use a third-party appraisal management company. So I'll make that known to the listing agent as well. And what we're trying to do is make other aspects of the contract, of the offer, more appealing so that our buyer doesn't have to just shoot the moon and pay the highest price, because price is a big part of the offer, but it's not the only part. And so we are proactive in trying to make sure that our buyer's offer is accepted by reaching out and making sure that the seller is aware of the strengths of the financing aspects of that offer.
All right. Final question is concerning pulling money from 401ks. You know, there are some provisions that allow first-time home buyers to pull from qualified plans, and anyone can borrow from 401ks as long as there's a provision that allows that. Now, we may have a conflict between your answer and mine in that respect, but what's your opinion of that? Since there was a question that came in.
I will try to tread lightly. I don't think I like the idea of withdrawing funds from the 401k. I have always, I'll just say I have not discouraged buyers from borrowing from their 401k, because in the end, they're going to be replacing what they've put into the 401k. And those terms are usually fairly lenient, 3 or 5 years. And at the end of that term, you're whole. You still now have your retirement investments intact rather than withdrawing. I will say this, I'm not a tax professional, and I very much hesitate to talk about whether a buyer is qualified to withdraw from a 401k without tax implications, because I'm not qualified to make that recommendation. So I'm much more comfortable with the idea of borrowing versus withdrawing. And I'll ask what your answer is now.
We hate to see money coming out of retirement accounts to fund anything other than retirement. So we encourage people to keep monies invested whenever they can. Yeah. There are always circumstances and exceptions. We won't have time for the question on this, but I really like your comment about reliable, experienced local mortgage brokers. And you want to expand just briefly on that?
Yeah, so most particularly local and reliable. But the bottom line is that if you're dealing with someone who's lives in the same community that you are, and in particular relies on referrals for their business, then that in and of itself, it is inherently more important for that loan officer to do a good job for you, because their future business referrals are dependent upon whether you do a good job, you deliver accurate, timely information, and the process goes smoothly. If the further away you are from your lender, I think the easier it is for you to become just a number. And so that's a big part of why I think it's important to deal with someone locally. And then experience is a real key factor, because there are a lot of pitfalls out there, potential obstacles, that if you're not working with an experienced loan officer to uncover those potential pitfalls and find a way around them, then you may find yourself during the process, having some real frustrations, and in the worst case, the disappointment of not being able to close on your home purchase because the financing went south. So it's not just an online application and, oh, someone said I can get you a loan. And if you're starting to make serious commitments, and some of these contracts require serious financial commitments to get a house under contract, you need to make sure that you're working with a reliable financing partner.
Dan, fantastic. I'm sorry we couldn't get to all the questions, but we will get back to them. Coincidentally, you talked about credit. Our next meeting is going to be March the 18th. The topic is going to be managing and protecting your credit. So it dovetails very, very nicely with this. I can't thank you enough for participating in this with us. I think we need to do this again sometime in the future and expand the audience a little bit, if you would. But this is going to make a great video for us. Go obviously to our website if you would like to share this with someone else, and they're all available. So again, Dan, can't thank you enough. Appreciate it quite a bit. And for everyone out there, have a good evening. We'll see you again on the 18th.
Thanks, folks.